Well, Mike and Ryan, I want to thank you guys for taking the time to really just explain what's been going on over the past quarter, because it's a completely about-face quarter from the one before. And anyways, there's obviously lots going on, so I'm really looking forward to going through all the details today. So maybe just, I'll just pass it over to you and we can dive right into things.
Sounds good, Scott. It's always refreshing to give an update after an awesome quarter one and start to the year. Every month's been positive so far: January, February, March, April. May's a little bit bumpier now, but it's nice to come out after a pretty solid start to the year. A quick reminder: here's the Connor Clark and Lana investment platform, or toolbox, if you will. And throughout the discussion, we'll talk about stocks and bonds and cash in different markets, as well as a bunch of alternative investments, how they play a role in things. And Ryan's going to talk a fair bit about where we see the markets, where we sit in the market cycle right now, and what kind of decisions we're making based on that. But we've got a lot of tools in the toolbox. We are very forward thinking around what's coming, and we try to respond to that to take advantage of opportunities and to protect where things are getting a little bit more tough. So yeah, we'll cover the performance highlights for last year to date. Some of the economic. Ryan will talk about the economic factors driving the markets, some of the investment market themes, and our outlook, and I'll close off on the portfolio positioning. So last year, just a reminder, not an easy year for stocks. The only reason U.S. stocks went up at all is because the U.S. dollar appreciated so much. It was up 4.2. Bonds eked out a positive return for the year, up 1.4, and that was all very heavy in quarter four. You can see quarter four was 1.8%, and for the year it was up 1.4. Quarter four was really tough on stocks right across the board, down 10, 7.5, 8.6. And so for the year, the numbers end up being negative, and that was all driven by quarter four's volatility. Interest rates moved up throughout the year. They started to come off a little bit towards the tail end. Global growth is slowing is kind of a common theme these days, and the U.S.-China trade concerns continue to be a daily factor in day-to-day volatility. So this is last year. Remember this when we want to show you the updates for this year. But 2018, there's no place to hide. The only place to make money was in the U.S. dollar, which I talked about, up 8.3. Short-term bonds and more traditional conservative bonds up a little bit, but you can see how everything else, even high yield bonds in the U.S. down, U.S. equities down in U.S. dollar terms, and right across the board, oil being down the most at 38. Pretty difficult market, and very tail end heavy in quarter four. Quarter one, very different story. So you can see Canadian equities leading the way, being the most negative performer last year, up the most this year at 13.3. U.S. equities up 11 in Canadian dollars, international up almost 8, bonds up 4% approximately in 3 months, which is pretty impressive. And what's driven that is interest rates declining. Central banks decided to go on hold quarter four last year. There's a lot of concern that central banks would raise rates maybe 2, 3, even 4 times this year, and that sentiment changed very quickly at the beginning of the year. And now Canada and the U.S. are both saying that they're going to be on hold for the remainder of this year. And as Scott said, very different quarter. If you look at quarter four in gold, quarter one in purple, whatever worked, what didn't work in quarter four is working in quarter one. Whatever worked in quarter four is not working in quarter one, and vice versa. So whether it be growth style or value, more income style investing, U.S. Developed markets, emerging, whatever worked last quarter is not working this quarter, and vice versa. So I've used this analogy before. The markets sometimes work like a light switch. It's either risk on or risk off, and different things work in that risk on or risk off environment. And this is just a case in point. Very different story from one quarter to the next. Now, what's contributed to the strong returns this quarter? Pretty much everything. I mean, any kind of higher risk asset or stocks in general, whether it be financials, defensive names, resources, cyclicals, value investing, growth investing, they all did well. It just, whatever is risk on, like growth, resource or cyclicals, did better than more defensive names like financials or defensive companies. Value investing underperformed a little bit, but all very positive results. Canadian dollar appreciated a fair bit in quarter one, and so that's one of the things that's contributed to Canada looking better than the U.S. international on an after currency basis. Here's all the numbers comparing, again, the markets in purple versus us in the gold. High yield bonds had a really good start to the year. Canadian growthy equities like small companies are outperforming more defensive names like income stocks, dividend stocks, value stocks. Right across the board, our U.S. and international portfolios are doing very well. Multi-strategy had an up quarter, up 2.8 after a pretty tough quarter last year in quarter four. And for just quarter four, real estate, infrastructure, private loans, all up 1.5% to 2% when the markets were down quite dramatically in quarter four. So adding some good value there. And the one-year numbers are more like plus 12% for real estate, up around 8% for infrastructure, up around 7 or 8% for private loans. So very attractive on a risk-adjusted basis in those asset classes.
Now, I've just got a quick question on, and maybe you're going to cover this, but I just want to ask it now because we're seeing such an about face in the performance. I mean, what we're seeing here in this Q1 2019 performance, is those are fantastic annual numbers, and that was a 3-month period. Is it not sort of as a result of leading up to that point, or leading up to the fourth quarter of last year, there was all these statements from the feds and from the Bank of Canada saying, our plans are to increase interest rates, and then they get to the end of the year and they say, okay, our plans are we're going to hold steady. And all of a sudden, there's almost this about face. Does that not leading sort of that rationale as to why all of a sudden things just start to recover?
Absolutely. The market sentiment. So people, the market investing public feared that rates would go up a lot this year, and that the U.S.-China discussions wouldn't go well. Those are the two major factors that drove the markets down in quarter four. And when those market sentiments were shown to be wrong, and actually the governments decided to pull back on their original statement around how much rates would go up, and now they're on hold, and U.S. and China are talking, and it's going down a positive path, everything had to be reversed. So all the negative from quarter four had to be reversed, and then it had to kind of normalize. And so if you were net invested October 1st to now, you've made money. Not if you sold on December 24th, which was kind of the interim bottom. Christmas Eve was a great time to get invested. It just didn't feel good, but it was the right time to get invested because the market had overshot to the negative because of emotion.
So is that then not the I guess the government's or the Fed saying, and I say the Feds, and then I sort of move everything, both U.S. and Canadian, and lump it into the sort of the statement of the Feds. But is that not them saying we're kind of acknowledging that the growth rates we believed were going to be taking place are actually not? Because if they're saying, hey, we want to keep interest rates low, or we're not going to increase interest rates, I would think that would be an indication that they're just not as optimistic, so to speak.
Yeah, the numbers haven't changed that dramatically, but there definitely is, and Ryan will cover a lot of these charts, we're seeing slowing growth. It's not super negative, but it's not as positive as it was. And I think the government's just wanted to raise rates as much as humanly possible because they want to have some gas in the tank in case a recession comes around the corner in 2 to 3 years' time. The number one tool in the toolbox to get out of a recession is to lower rates. You can't do that if rates are at zero, right? So they had to increase rates. They had to do it in a meaningful way over time, but they're doing it very tentatively. So if rates go up and the market reacts highly negative, then they tend to kind of slow down a little bit. So it's assuring to see that the governments are moving at a slow pace around interest rates moving up. And if the markets can't sustain it, the economy can't sustain it, they'll stay on hold. So that's healthy. And so I have to commend the government for trying to do the right things around monetary policy right now. Current yield is a strong predictor of future return. This is just looking at the universe bond yield and a future 10-year annualized return. So it shows that there's significantly positive correlation there. The current rates for bonds are 2.4%. And so we'd expect that the 10-year return to be somewhere around that. Somewhere in the 2 to 3% range is a normal expected return out of bonds. In a recession, the returns will be a lot better because interest rates will drop. So it's still a very important tool to have in the toolbox. But one of the things we've talked to people about is that multi-strategy has not had the best 2 or 3 year track record. And quarter four in particular, where hedging strategies were down 4.5%, bonds were actually up 1.7%. So quarter four was a really tough quarter for that. Over time, though, this fund has done as good or better than bonds, or pretty close to it. But moving forward, I guess the point is we'd expect the hurdle rate is 2.4. If we can do better than 2.4 in multi-strategy, it's a good tool to have in the toolbox. And our expectation is that we do over 6. So we're feeling quite confident in having a good allocation to that. And we've even modeled out over time, this going back to 2009, you can see how different asset classes perform at different times. And hedging strategies tend to add value a good portion of the time relative to cash or bonds or just a balanced approach in general. We think, balanced portfolio, 4 to 5% would be a decent outcome in a balanced portfolio of stocks and bonds. If hedging strategies can do 6 plus, it's going to be a value-added component of the portfolio. I'm going to turn things over to Ryan. He's going to talk a little bit about the investment market themes and the outlook, and he might cherry pick some slides more than others, just in the interest of time. But take it away, Ryan.
Yeah, thanks, Mike. As Mike alluded to, what a difference a quarter can make. So here we see the equity market split between the world and Canada, essentially equal. And we'll look back to the last 4 quarters, going back all the way to Q2 of 2018, coming off a correction in Q1 of 2018. And I'll focus on the second half of the page where you see Q4. And to your point, Scott, if you look at that peak of the market early in Q4, you'll see essentially the peak coinciding with some comments coming out of the Fed, particularly around rates. And at that time, what they felt was not at their neutral rate. And we'll talk a little bit about that neutral rate as well. And that bottom, or that trough of that market in Q4, as Mike mentioned, Christmas Eve, where a lot of things were at a discount in the equity market, and the recovery thus far through Q1. And especially the Fed coming back out and saying not only are we paused, but we won't see any rate hikes in 2019 and potentially only one in 2020, most importantly, really driven by data in terms of what they see in the U.S. economy and the globe as well. So as we move on and we think about some of the risks that we felt were prevalent in 2018, and we look back in what's the current status of those. So interest rate rises, we know that's on pause. U.S. dollar gaining value, had a great year last year, as Mike mentioned, but temporarily gone away. And we'll talk about the U.S. dollar a little bit, especially concerning emerging markets, because they seem to be the most affected as their debt is priced in the U.S. dollars. Trade tariffs, they were improving. A little timely for this call. We see some more speak about that this week. Global growth, of course, potentially bottoming. We feel like the trend is important. So we do see a slowing, as Mike mentioned, but we do believe there's potential for a bit of an acceleration in the second half of this year, but certainly not off the highs we've seen in the recent past. When we look at valuations in the equity market, and this is specific to the S&P 500 or U.S. stocks, currently trading at about 16.5 times, and that's what we call a price to earnings multiple. And just as a reminder, that determines what an investor is willing to pay for $1 worth of earnings. So that current number of 16.5 means that an investor is willing to pay $16.50 for $1 worth of earnings off a company's operations. When you compare that to other periods, the average going back to the bottom of the financial crisis of 2008, we're actually trading below average. When we go back over the last 25 years, more normally valued trading in around that average of 16.2 times. So you can see how that shifts over time as well. And you'll also get a sense on the next slide as we look to the globe and Canada's, what we're willing to pay for $1 worth of earnings in Canada versus the US versus Europe in terms of earnings growth. So we expect growth off equity companies or companies to come in on average about 6%. We do believe that could weaken going into the end of 2019, but you'll see it's fairly around that average of 6% globally, with emerging markets coming in a little higher than that at the 9%. So then when you translate that information into global stock prices or the valuations on the next slide, you'll see what we expect going forward. So again, the world average of 15.3 times, the US at 16.5 there, Canada coming in a little below average on the world at 14.5 times, and Europe and the emerging market as well. In terms of our positioning, and Mike will talk about this a little bit later on, but we've also used it as an opportunity to shrink the variance or the overweight to the globe in the equity market of the portfolio versus the Canadian market. And then in terms of looking to Europe, being very selective and tactical in what companies we add, as well as the emerging markets as well.
So bottom line, when you look at these charts, it's not all doom and gloom. Yet there's all this talk about this impending recession. I mean, growth is pretty strong. Price to earnings or value in the market is actually still pretty reasonable. It's not like it's the tech bubble here and people are paying some kind of crazy price for stocks. It's still pretty reasonable valuations considering the growth that we're experiencing.
Thanks, Mike. So here we see global trade and the effect it has on corporate earnings. And you'll see the sales and trade on the left side of the chart there. Gold representing the percentage change in world exports, and we see that certainly coming down, and the purple line representing the percentage change in sales growth. And then on the opposing slide, you'll see profit margins, and profit margins remain actually quite high. We shift to the bond market, and there's been a lot of discussion recently around what we call the yield curve, and that's essentially time versus yield, or what you expect as a yield from a bond portion, and how long you're willing to take in terms of being a short-term or a longer-term bond, a 2-year versus a 10 versus a potentially 30. Here we're going back all the way to 1976, and what we're looking at is the yield curve of the U.S. Treasuries, so the 10-year Treasury yield minus the 2-year number. And that's essentially giving us what that trend line looks like. Those bluish bars you see are recessionary periods, and the circles in purple you see as what we call an inversion of that yield curve, meaning the long end of the curve is actually paying a lower yield than the shorter end of the curve. And that is historically been a good signifier of a recessionary period. Now, it's been a better predictor in the US than it has been in Canada, but as you can see, it's certainly a good predictor before a recessionary period hits. What it's more inconsistent about is the timing, and that timing lags anywhere from a 6-month to a 20-month, 24-month period in terms of when that potentially can see a recessionary period. So there's been talk of portions of the U.S. Treasury yield curve inverting. It is certainly much flatter than it has been in the past. We believe it's not something that will take hold. We believe that there's a greater probability that it'll steepen, meaning long rates, long yields will increase over time. So we look at why we hold bonds, and bonds will always be a good hedge against volatility in the equity market and provide a good deal of stability. But we also know that there's less stability today than there has been in the past. And we say that with a high degree of confidence because with rates being so low, there really is only one direction. And this opposite relationship between bond prices and rates means as rates increase in value over time, it pulls the prices of these bonds down. So you can see if bond returns or bonds were expected, the yield on those bonds was expected to rise by about 1%, you'd see the total return we'd expect from a bond component of the portfolio. You can see as right now, currently as low as negative 5.5%. Again, if yields were to increase by about 1%. And then you equate that to current yields, and yields historically remain low. Short bonds earning about 2%, core bonds not earning much of a premium there at 2.3%, and high yield a little higher at about 4.5 to 5%, where we're taking on more credit rate type risk.
Now, having said that, we don't expect interest rates to go up at all anymore this year. And so if interest rates don't go up, you're not going to see a negative return. Don't want to spook everybody, but if it happened that rates did go up 1%, this could be the outcome in bonds. So you just got to factor in the fact that rates moving up is not good for bonds.
And to that point, another good point where the multi-strategy portfolio, when it can be utilized, makes some sense given the potential that it has in certain areas of the market cycle as well. Here we're looking at the Canadian dollar. We'll see long-term average of about 83 cents, currently trading between the 74 and 75 cent window, so below the longer-term average. And we've seen the Canadian dollar strengthen a little bit as well, and that's certainly detracted from global equity returns, as Mike mentioned earlier. We look at many different things when we're looking and speaking about asset mix decisions, and certainly this list is not exhaustive. And really, we look at trends as opposed to singular data points. But a few things on our mind over time you'll see listed here, and a few updates on the current quarter. Purchasing manager surveys. We'll look at those PMIs. Currently, they've declined. And they have continued to decline, but they're still from a strong place. It's still a good number, but again, the trend is a little weaker than it has been in the past. We see valuations that have declined while inflation has slightly increased. Unemployment at a really low number, as unemployment certainly has declined. We have seen wage growth, especially in the U.S., but not to the point where it's above that 4% threshold, which we believe is a good indicator. Yield curve inverting, I mentioned that. We certainly haven't seen that. We have seen a flattening of the yield curve, and we do believe there's potential for it to steepen, again, meaning longer rates would increase. The cost of capital greater than the return of capital, and certainly we haven't seen that as the cost of capital has increased as well. And cash flows to debt and ratio has deteriorated. So we certainly don't see that as an impeding signal as of yet. So when we look to the economy, and the next slide is a really good summary, and one of my favorite slides is we see the three best indicators here, whether that be economic growth, which has, we believe, come off its highs and certainly is weaker, at least the trend is weaker, although the ultimate underlying data is still quite strong, especially coming out of the U.S. We've seen inflation be a little bit lower, again, than it has been in the past. There is a risk that with costs of energy and oil prices, there's potential for that to peg or tick up that rate of inflation. Monetary policy, that has probably become less of a risk. We certainly have more clarity in terms of central bank policy. Bank of Canada, the Fed, as we've mentioned, the Bank of England, all essentially hitting that pause button. And then certainly China being very stimulative of their economy. And as they work on this manufacturing base, trying to transition to more of a domestic service-based economy over time as well. So this is the central bank, what we call peg sheet or dot plot, if you will, and it really shows expectations of what the Fed has shared. And if we were to go back to previous quarters, that purple line would have been much higher. And that October speech really marked, where we saw in the first slide here, really marked the beginning of what we saw as a correctionary period, and then a pause leading up to the recovery. And the definition of this neutral rate that we always hear about is really a point where the Federal Reserve Bank says that the rate they peg doesn't stimulate the economy, nor does it detract from the economy. So they're trying to find this equal balance between not adding value, but not detracting value from the economy. And right now, in the short term, they feel they've hit it. And they've also said they'll be more data dependent going forward, making sure that the economy can sustain any potential rate increases going forward. But of course, we don't believe we'll see any rate increases for the duration of 2019. So the next few slides are very economic dependent, Canada and the rest of the world. So maybe we'll spend a little less time on them. Scott, if you have any questions, though, feel free. Here's that PMI slide coming off a high in 2018 of 58.8. 50 is the threshold. Anything above 50 is certainly positive in a growing economy of that purchasing manager index survey. We have seen that trickle down a little bit. So the trend is weakening, but still coming off very good and solid numbers on the high side.
And you can see a pretty significant difference from what we experienced in 2008, 2009, back in 2001. Clearly, we're not in that kind of environment. So for anybody that's doom and gloom, these numbers are more or less at all-time highs, nowhere near what we experienced back in these times.
Some of the things we've already mentioned, whether that be inflation in the U.S. or wage growth in the U.S., you can see inflation at around the longer-term target, although it remains slightly below. And we also see rising wage growth. So we don't really see inflation being impacted by higher wages, although they still aren't above that 4% mark that we've seen historically. That would lead us to believe anything different. We work to the U.S. unemployment rate, certainly at historic lows, around 3.8%, and retail sales, which have come off their highs, but still quite strong and still in positive territory. And you can see that big dip going back to the financial crisis of 2008, certainly above that. Political uncertainty always becomes a headline and makes people nervous, especially where corporations are concerned. U.S. business confidence has certainly declined as geopolitical risks have come to fruition, and we've seen capital expenditures be a little more volatile over time, as well as companies just aren't sure what the political landscape will look like, and that certainly can make that a little more volatile when they're looking to put money to work in their own companies and reinvest. In terms of Europe, we see continuation of very slow growth. You see net trades there versus GDP. Growth in GDP still positive, not on the negative side as of yet. Household consumption also slowing, but again, still positive. So I think the overall summary would be the trends are becoming a little weaker, but certainly not negative, and certainly coming from very high areas as well.
Yeah, kind of similar themes in China. These numbers are trending positive here in terms of Purchasing Managers Index. They have generally been slowing since 2009, but still pretty good numbers in the positive range above 50. It's kind of similar story right around the world. Since I kind of jumped in on Ryan there, I may as well continue and talk about portfolio positioning. This is a chart that kind of shows all the major asset classes outside of alternative investments, which we still really favor. So we really like multi-strategy, real estate, infrastructure, private loans. But if you're just looking at the more traditional world, we're underweight on the Canadian side. We do favor small companies more so than large. Same thing on the global side, which we favor in general. We prefer small companies over large companies. But recently we have been a little bit more underweight equities. Throughout last year, we did take some risk off the table. So when Q4 hit and it was quite negative, we weren't as exposed as we might otherwise be. And on the fixed income side, we've really reduced our weighting to high yield bonds just because there's higher risk attached when the markets are volatile. And so we've tended to prefer short term and core bonds over cash and high yield. More of the same here. We've been getting more defensive around the portfolios. In Canada, we've been overweight, the banks as an example. On the global side, overweight consumer staples and healthcare. Fixed income, we've been very active around playing the yield curve in terms of where we want to be based on where rates are going up or down. But we've really tried to improve the quality across the portfolio, just taking a little bit of risk off the table there. And real estate, we're looking to continue to buy and improve the assets in the portfolio. It's a high quality portfolio already. Over $4 billion worth of real estate that we hold now across like 200 plus properties. Infrastructure, we're looking at a much more diverse range of opportunities. We've got $2 billion in the pipeline, and we're only looking to deploy $500 million. So we're hoping to be able to deploy some capital there. And private loans, the banks have kind of stepped into our range of deal size recently, but now they're kind of stepping back out. We're seeing a lot of deal flow, and recently we've put some good money to work. So we think the next year or two will be a good time to deploy some capital into these areas. As Ryan said, we're into this kind of contraction phase of the business cycle a little bit. We're not quite at the point where we want to take maximum risk off. We're still seeing opportunities in the market, so we're not going significantly underweight stocks. And I think investors should just remind themselves that it's not all ugly out there. In fact, it's more positive than negative. And as long as you're diversified, volatility is normal, ups and downs like you saw in Q4. Keep a long-term time horizon. Cash is not king. Usually it's, it's always priced as a guaranteed loser after tax and inflation. And time is your friend in the markets. It's just you want a manager to be active during that, which we definitely are. Here's just an interesting market stat, and we've shared this in the past, but if you miss just the best 30 days over the last 20 years, you ended up with a negative return. So it's pretty significant. Trying to time these things is very difficult. If you want to look back in time, obviously December 24th was the time to lean in and buy, but people weren't really feeling it back then. And typically, if you're counterintuitive about how you're investing, usually that tends to lead to better results. So look for the dips, and there has been some dips recently in May relative to January and April. Maybe not a bad time to put a little bit of money in.
Clearly, the doom and gloom, I guess, messaging that's in the marketplace is not being substantiated by the numbers that you're showing. There is a bit of a slowing pace that you're saying we're starting to see, but it's not a doom and gloom story. And so, I think that to me is what the big takeaway that I got from your material today is just to say, hey, it's not the doom and gloom. We aren't at the end of the cycle. We're not going into this recession. We're not doing. It's not all this negative experience. It's just it's kind of business as usual. But what's critically important is making sure you've got a lot of tools available to you in your toolbox, and that's clearly what you guys are making available. So I appreciate that.
And I think for any client that wants to incorporate alternative investments, I mean, many clients already have, but if it's not the right commitment amount, it's not the right allocation. I think some of the bottom line is we don't think a recession is right around the corner. It might be 2 to 3 years away. So you need time to deploy money into these different alternatives. But if commitments are made today, then over the next year, 2 years, 3 years, we can deploy some capital into these strategies, and you're going to see the impact on risk and return. There's kind of an industry chart of return and risk. And if you only invested in stocks and bonds, 5% is maybe a reasonable rate of return for a 60-40 mix. But why not consider adding a small allocation to each of these alternative investments to reduce the risk and enhance the return? It's having your cake and eating it too. So, there is, different things you need to consider, like liquidity. These things don't trade every day in the market like stocks and bonds do. But if you're a long-term investor, and as long as you got access to the money you need from a cash flow standpoint, they can really improve the return and reduce the volatility of your portfolio.
Well, yeah, I like cake, so I like alternatives. All right, guys. Well, listen, thanks so much for taking the time. I really appreciate you going through that and just sort of really painting the picture for what's happened, how strong sort of the first quarter was, but also how things, the doom and gloom story really isn't substantiated. So I'm really hoping that just gives people some sense of peace and sense of confidence that continuing doing what they're doing and making sure that they're, as long as they've been set up properly from the get-go, just continue the course and over the long period of time, not missing those critical days. I mean, that chart that shows missing those 30 days over a 20-year period takes away all the return. Well, those days are critical. So maintaining a focus and maintaining a discipline are important.
And the markets are a leading economic indicator. And if this year's any indication, things aren't that bad. And the markets wouldn't be up 4 months in a row if things were that bad.
Yeah. Great. Well, guys, thank you. And as always, I love going through this, and we look forward to our discussion next quarter once that unfolds.